Good morning, uh, friends and the Times Network. Thank you for organizing what is now a path-breaking conference in terms of India Economic Conclave and getting the focus on the economy, which is what we all need. I'm supposed to be speaking on the status of the financial sector in the context of the economy, and I'm really happy to speak with many known faces, including Nikunj and Nayantara, who are right here, to share with you some of my thoughts on what's happening and where do we go from here. First, I think it is time for us now to really think about reimagining our financial sector. We are at a very crucial juncture in our history, and I do believe that the time is now. In that context, just to get a sense of where are we, and it brings me to 4 or 5 key facts as we look at India today. Number one, India is in the classic Darwinian mode of what I call as the survival of the fittest. And sector after sector has seen that it is going to be more and more consolidated than ever before. And the consolidation in the Indian economy is happening more out of mortality and less out of combinations. And if I just look back at some of the sectors, think about the airline sector. In the last many years, we have seen a Kingfisher, a Jet, a Deccan, and a Sahara go out of business. And the fitter players who have survived have actually prospered. And I do believe it is the balanced consolidatees, or consolidators rather. Consolidatees, very few because most of it is to mortality, but consolidators are the ones who benefit disproportionately out of this consolidation phase. We are seeing a similar situation, friends, in the telecom sector, where again, we used to be 13 players, other than BSNL, MTNL, and we are now down to 3. And consolidation is really becoming furious and fast. I was yesterday talking to somebody from the wind energy supply systems sector. They used to have 19 players. We are down to 3. And this is the speed of consolidation. And I do believe that this wave of consolidation is now playing itself out in 2 additional sectors. Number 1, real estate, and number 2, finance. We are also at a time where clean business and governance are coming to the fore. And we are moving to a situation of what I call as a significant purging of the way business used to be done in the past to a way where I think clean business and high governance will be deeply valued by the markets as also as the basis of survival and growth. Therefore, moving to a cleaner platform and governance, and for most existing businesses, making this transition quickly is going to be the name of the day, because or else you will falter and effectively be a prey to what could be potential mortality. Third, IBC. IBC took long, but is a success. In my view, the SR Steel judgment by the Supreme Court and the efforts made by the government to transition to a significantly improved IBC process is something which is truly path-breaking. I think for the first time, combination of governance, better business practices, and ability of the system to ensure that if a business is not doing well, to find resolution or mortality quickly is the name of the day. And therefore, the new resolution framework which has come out of IBC is one of the major developments in our jurisprudence and law. It will enable us to move quicker. It will make it possible for lenders to go out and lend knowing that there is, if things went wrong, there is an exit mechanism. So that, I think, is a major path-breaking development, and in that case, the latest judgment is a big one. Fourth, financial sector. And it is here that I do believe that applying the IBC process to the NBFC sector is the right step. Because when you have lenders across banks, mutual funds, insurance, and different segments, and you do not have a mechanism through which you can find a common resolution platform, it was becoming challenging. And therefore, a IBC framework gives a legal basis for all the lenders to participate. And therefore, making IBC applicable to the financial sector is a big step. And one other major change I find in a positive way is the approach to policy. Historically, in the financial sector in particular, the approach to policy has been, oh, this cannot be done. We will make the rules tight, and we really need to figure out how not to do things rather than how to do things. The policy framework today is getting to be far more open and not bound by the dogmas of the past. And I think this is a positive step. It will play itself out in time and bring in significant change in the way we run our financial sector in the future. The question is, this is where we are. Where do we go from here? And here are some points which I would like to share with you. One of the biggest challenges in Indian finance is that the Indian saver is traditionally risk averse, prefers gold, for a long time has, and prefers relatively risk-free financial assets. Therefore, fixed deposits, insurance policies, debt funds. But it's only in recent times that we have seen some move towards risk capital, which is equity. I think the time has come for us to dramatically increase moving domestic savings into domestic risk capital with checks and balances. And I'll just give you where we really need to change our mindsets as we go forward. We are all aware that in 1992, we had a security scam. Okay? Post that, the way the policy framework developed, equities became a bad word. And in those days, if you remember, there was the Janki Raman Committee report, there was the JPC, there was a big noise in Parliament, and we saw tighter regulation come in. In 1992, post all this, one of the regulations which came in is banks cannot lend against capital market instruments more than 20 lakhs of rupees. It's a 1992 era. That law still remains. We need to rethink and reimagine how, if we are going to move towards a more risk-based capital system, how do we move our policy consistent with the changing times? I'm of the view that we need to manage risk, but not try and avoid risk. Risk is inevitable. Trying to avoid risk is not the answer. Managing risk is the answer. And therefore, a number which was 20 lakhs, we need to ask two questions. Do we need that at all? Or leave it to the risk management of banks? Or even if we need it, what should that number be? Why should it be 20 lakhs, a number which was picked out of thin air in 1992? Similarly, I talked about exit policy and resolution, which is now being introduced as IBC process in the NBFC sector. We have to ask the tough question that on the one hand, we are opening more and more avenues of entry of banks. We have got new policy, which is on-tap licensing policy for banks. We have recently announced a policy for small finance banks. A number of new banks are coming in. We also have a banking sector, which has the cooperative banks, the private sector banks, and the public sector banks. So as you are allowing entry into banking, we should be thinking more about the exit policy. And one of the important bills which was planned earlier was the Financial Resolution and Deposit Insurance Bill. We need to rework on that. Historically, if you look at it, as far as private sector banks are concerned, historically, they have not had an exit policy. They have normally been merged with some public sector bank. But as we go forward, it is important for us to have a FRDI policy in place so that should things go wrong, and it will when you have a number of players in an industry which is consolidating, in a world where it is survival of the fittest, to put a policy in place for exit in the banking sector. And I think FRDI, the time is now, just as the government has been bold on IBC and introducing of IBC for NBFCs, time has come for us to now really focus on structural issues in banking. We have also, at the same time, seen some developments in public sector banking, and we saw first the merger of State Bank with its subsidiaries. Then we saw the Bank of Baroda merger with 2 other public sector banks. The government has now announced 4 public sector banks which will be leading the merger between them. And hopefully by end of March 2020, we will be down to 12 public sector banks. So I think there is a significant development which has happened here. And the question I ask is, from 12, where? And I have been thinking about this. I've spoken about it also. And I was just trying to dream and imagine what could the potential solutions be. So one of the solutions which does come to my mind is, if you take the top 2, which is SBI and Bank of Baroda post-merger, and the 4 more which are getting merged into larger banks, I would say 6 out of 12, let's keep them as core public sector banks. That still leaves us with 6. For the balance 6, can we think bolder? Can we think at least 3 out of the 6? Move them, whereby through raising capital in the markets, we let the ownership go below 50%. Is it something which is possible for us to think about at this stage of evolution? Therefore, the first 6 continue to be public sector. They are already the large banks. Let them grow and develop within the framework of the banking sector. 3 out of the balance 6, can we think about through capital markets, raising capital and letting them go below 50%. Very often I'm asked that if you did that, depositors who have comfort of the government, what will happen? Maybe the government can think for some sort of a protection for a limited period of time, say 3 years or something. And beyond that, they become free market players in the marketplace. So that is one potential thought for 3 out of the balance 6. And can we then further reimagine that the last 3, can we think out of the box public-private partnership? So then we have a set of 12 public sector banks, 6 moving as strong public sector banks post-mergers. Each of them would have had some sort of a merger. Out of the balance 6, letting 3 go into becoming broad-based, widely held banks. And for the 3, is it possible to be thinking about public sector, public-private partnership? So this is something which I think time for us to at least think, maybe dream, think and speak has come. Time for implementation is something which the environment and the policy framework will determine. The next big area where I feel we need to move is the bond markets. And we need to make major changes. There has been an enormous amount of lip service. Every committee, every meeting, there has been talk. We need to develop our bond markets. But if we are going to make our corporate sector competitive, we need to have very deep and vibrant bond markets. For a long time, the problem was our bond markets were did not have deep pools of capital. We now have it. We have the pension industry which is developed. We have the life insurance industry which is much better developed. So there is deep pool of savings now available. I think for the first step, a dramatic focus is required on a number of what I call as structural and plumbing measures. 1, standardization of bond terms, maturities, cash flows, standardization of terms. Second, activating the repo market. And within that, I think there are issues about, for us as a bank, if we sort of sold a bond in a repo market, the funds we get are subject to reserves, CRR and SLR. Can we get around that? SEBI has to revisit. So far, SEBI does not allow mutual funds participating in the repo market. And third, if a buyer of a repo buys it from another company, how do you ensure that it is bankruptcy remote from that company or an IBC remote from that company? Therefore, are a number of areas which need to be addressed in the bond markets. But bond markets are the next big thing which we need to think about. And last, I think, friends, time has come for us to dramatically build confidence and trust. And confidence and trust cannot be built only by words. It has to be by data, by action, by numbers. And therefore, if there are pockets of the NBFC sector which feel that they are not getting funding, my advice would be come out, or maybe some sort of a detailed analysis, reporting, give details, give data, give facts, because concerns about related party transactions and governance are something which are not enabling building of confidence and trust. And especially in the last few years, when bond investors and investors in general have been disappointed by auditors and raters, time for confidence building lies much more with the companies themselves to reach out and give a lot more data. And along with that, be ready to raise capital, even if the prices are not great. Get yourself capital strong, or else it's extremely difficult to build confidence in an era where the confidence level in auditors and raters needs to get better. And lastly, friends, when I think about the Indian financial sector and the economy, I'm looking forward to best-in-class quality, but strong Indian-owned and controlled financial sector. And we do need, while we must attract foreign capital, we must ensure that there is no colonialization of Indian finance. Thank you very much, ladies and gentlemen.
Note, Mr. Kotak, if you could just stay on stage for a second more, and